Well, I think the first place to start is most people always anticipate crisis and say, oh, it's going to happen. The fact of the matter is, crises always take a long time to arrive and then happen much more quickly than you think. And the crucial thing to remember is this expansion, so called, is very long. It started in 2009 and is going through to 2016. And as the old saying goes, trees don't grow and touch the sky. The second element, which I think is really important, is this is a fake rally because it's manufactured. And it was manufactured by central banks and policymakers for a whole bunch of reasons, one of which was to really save the banks from the problems in 2008, 2009 by boosting asset values. And then they assumed that if people had the wealth effect, they felt wealthier, they would spend more and growth and inflation would come back to the levels needed to address the basic condition, which was too much debt. And that hasn't happened. And what we now have is a very interesting situation where, firstly, the conditions that you need for a crisis are all falling into place, plus you've got a lot of triggers. So one way to think about it, there's a lot of kindling and people are walking around flicking lighters a lot. So the chances of a crisis is much higher than it has been at any point in time since 2009. Let's look at the conditions. I think all crises have three basic things which have to be in place. The first and most important, in my view, is overvaluation. And we now have equities which are grossly overvalued, but then all asset classes are overvalued. And if you actually look at equities, for instance, it's kind of curious. The US market, for instance, has tripled in value since 2009. But then you look around the world and you find that very few markets have actually gone back to the levels of, say, 2008, 2009, or even 2001. So it's not very broadly based. Then you dig down into the US market, for instance, and you look at the number of stocks which have really done well. And it's actually quite a small subsection of stocks. So it's not very widely based. So the recovery is kind of odd. And I'll give you the example of Australia. Everybody keeps looking at, and I look at my fund manager reports, which mysteriously show that they're returning 15, 16%, but that's year on year. But if you actually go back to 2008, 2009, the stock market is still about 20% below those levels. And, people actually manufacture lovely metrics like, well, if I'd reinvested my dividends, I've got back. But that's all fake. So all those assets that we're talking about, risk assets like equities, are grossly overvalued. And you can take whatever measure. You can take PE ratios. You can look at things like market cap relative to an economy. They're all overvalued. And they're all assuming much greater levels of growth than we've seen and much higher levels of inflation than we've seen. And you can look at other asset classes. You have in bonds massive overvaluation because interest rates are negative. So you actually, in Switzerland, for instance, you can buy bonds for 30 years, which are locking in a loss, which makes absolutely no sense. And if you look around the world in terms of real estate, that's also overvalued. So you've got overvaluation in place. The second is always debt. For instance, if you have asset values which have no debt against them, it doesn't matter. You can sit it out. But once you have debt, the equation changes. And what most people think is since 2009, the world has been in this what we call deleveraging phase, which is reducing debt, except that hasn't happened. Debt today is $60 trillion more than it was globally in 2009. And that as a percentage of GDP is 17% up. And that's during a period where we're supposedly reducing debt. Then you look at even pockets of that, and you look at a country like China. Debt was $2 trillion in 2001. It was $7 trillion in 2009. Today, it's $28 trillion and rising. So debt is built up, and this debt is highly unstable because essentially, if you don't have growth, you don't have inflation, how are you going to service that? And the third level of this is always the ingredient, if you like. If you're making a dish, which is called a financial crisis, you've got to have overvaluation, you've basically got to have debt, and the last bit is you basically got to have a banking problem. And we have that. Today, there's more than $3 trillion worth of bad loans sitting around. The two major hotspots are basically Europe, where there's $1.3 trillion. If you look at Italy, they've got roughly a quarter of that, which means over 30% of all the loans they've ever made are not going to come back. And China, who knows what China's bad debt problems are, the IMF estimates it to be about 1.3 trillion. So we've got all of that. Now let's go back to 2009. What triggered the problems in 2008, 2009 was only $1 trillion of subprime loans. So you've got roughly 3 times that now. And the World Bank measures the percentage of bank assets which are non-performing, and they're at comparable levels to 2009. They're in fact slightly higher. So we've got all the ingredients assembled, so it's a matter of somebody putting them together. Look, we never know, because with the benefit of hindsight, we all can go back and say, oh, that was the magic moment. But I think there are certain things. One is an equity market meltdown. And the equity market meltdown is interesting at the moment, because I think it might be related to something else, which is currencies. The US dollar is going up. As the US dollar goes up, then you take away one of the things which has underpinned the US market, which, remember, is about a quarter of the world. And you look at that and you see, well, what did the lower dollar do? Well, it did a lot of things, and the US rally was pinned on foreign earnings of a lot of the US multinationals. Well, that's going to be affected effectively by a stronger dollar. But you've got some other things going on in the US, which is quite interesting. One is the rally was partly driven by oil and energy stocks, and obviously oil prices are off more than 50%, and that's going to have some effect. And the last element of that was, I think, very, very strongly the impetus coming from monetary expansion of low interest rates and QE. Well, QE is not on anymore, and interest rates may well be going up. So you could quickly see a problem in currencies coming up. That's number one. Number two, we've got a lot of sovereign debt around the world. You've got a lot of debt. So something going wrong is pretty straightforward. And the major catalyst for that, I think, is things like the energy sector, where there's a lot of money which has gone into the energy sector. Lending to energy sector is about $3 trillion globally. And given that all the commodity prices have come off 50, 60%, how do you keep servicing the same amount of debt with half the revenues is the challenge. And obviously some companies will be fine because they're not that over-leveraged, but there's a heck of a lot of people who are over-leveraged. Then you look at the amount of money that went into emerging markets. China owes foreign banks and so forth more than $1 trillion US. There's $9 trillion that went into emerging markets, of which roughly 2/3 was in foreign currencies. And a bulk of that would have been in US dollars. So if US dollar interest rates go up and the US dollar goes up, well, we don't know whether they can cover these liabilities. So you get these pockets of problems in currencies. Then I think you look at things like the banking crisis we've spoken about. Anything can go wrong in banks. At the moment, the Italians are scrambling to try to rescue their banking system. So that could trigger it. But I think the other things which are interesting is people forget that what we're talking about is the financial side of the economy. It's the real side of the economy that matters. And growth isn't there. Growth isn't there. And just think about it. This is poor growth after massive stimulus. So if you remove that stimulus, what do you have left? Roughly 50 to 60% of all growth is now related to central bank activities. So growth isn't going to come back. Inflation, I mean, people have been trying to create inflation, not because inflation's good, but deflation and debt is not a good combination. And that, all you need is, say, 2 or 3 quarters of really bad growth figures and 2 or 3 quarters of really bad inflation figures, and everybody looks at each other and goes, oh my God, this is not manageable, and that could trigger it. But the other concerns I have are not traditional concerns. One is, since 2009, the world has basically prayed to one God, which is central bankers. Now, these are the same central bankers who created the conditions for 2008, 2009, who are now looked upon as saviors, which is kind of anomalous anyway. But the point is, they don't have the tool. They don't have the ability to keep this going. They brought stability, but they're not going to be able to generate the growth and inflation needed to correct this. And at some point in time, people are going to look at them and say, well, the emperor's got no clothes. And essentially, at that point in time, I'm not sure what happens, and that could be an inflection point. The other thing is, I think essentially you've created lots of problems of inequality, lots of social stresses, and those could boil over. And one recent example, obviously, was Brexit. And I don't know how the US elections are going to play out, and they'll be interesting. But you've got other problems like a referendum in Italy, you've got elections in many countries in Europe. Any one of those things could lead to a moment where things just start to break apart. And the last element of all of this is geopolitical. Because if you look back geopolitically, we are in a really bad place. You know, the Cold War tensions between Russia and the West have reemerged. We've got Chinese tensions in the Far East. The Middle East is in very poor shape, and there's tensions there which are not resolvable. So you've got all of these things going on. Now, it's a case of roll the dice. Which one of those is going to trigger? And like all things, it'll be something unexpected. But what it will do is affect all these other factors. And it's like dominoes. Once they start to fall, they'll all fall together. So we have the conditions, we have the triggers. What we don't know is exactly who's going to throw the match in the fire. Well, I think all crises are different. So I don't think it'll be exactly the same. There'll be some differences. But I think people should remember that this crisis will be different for a number of reasons. One, the problems are much larger. One way the analogy I would use is you had a minor series of heart problems in 2008. You had chest pains, and there was probably a small minor heart attack. But you basically went back to smoking, eating red meat, drinking, and not exercising and being overweight. So the problems now are much larger. The second is, if you look at where we are today, it's worse for a second reason, which is we've got low growth, we've got low inflation, but it's global. So in 2008, 2009, the emerging markets were functioning really well, and the demand for that, to some extent, bailed out of the rest of the world. And there were two things. One is the demand from there, but second, they had excess money. They had excess capital, which could be used to bail out the West, which is not going to be there this time around. The third element is, it's like fighting a fire. You've got a certain amount of water, you've got a certain amount of resources, but we've spent it all. We've poured it all out. So interest rates are now at zero pretty much globally, or are going to be there. Balance sheets of governments are stretched. Tools are all pretty much exhausted. So the question is, what do you do? And that's really important. The third element, which I think people also underestimate, is people are tired. People have had 7 or 8 years of coping with this, and it was always, tomorrow will be better. There's a lovely line in Alice in Wonderland, jam tomorrow, jam yesterday, never jam today. And that's basically what people have lived through. And there's a point at which people just basically have fatigue, and they just can't cope with this. And as we were talking about earlier, geopolitically, we're in a much worse shape than 2008. So all of that will play out. So there's every chance, if we have a crisis, these factors will come into play and will determine the magnitude of this crisis.